G'day, I'm Bryce Robertson from Cultivate Collective, and we are very pleased and excited to be sharing with you the investment summary for Anchor Mobile Home Community, which is our latest investment opportunity. And we're really excited to present this to you today. So first off, before we dig in, let's just quickly dig into some important disclaimers here. We are not financial advisors. We're not CPAs. We are not legal advisors at any means at all. This here is for your educational purposes as well. You need to perform your own due diligence, do all your checks and balances, and you need to refer to your own CPA, financial advisor, and legal counsel to help guide you for your specific needs and circumstances. So we are really excited to present to you our third investment opportunity of the year, Anchor Mobile Home Park. Here's some actual photos of the property here. And this is the real investment summary that you guys have received in your inbox. So if you're receiving this, if you're watching this webinar right now, it's because you already have a pre-existing relationship with myself or Nolan, who is also on the webinar with me today, or any of our other sponsors that we're going to be talking about later on here. If you do not have a pre-existing relationship with our sponsors, then unfortunately you won't be able to join us on this particular investment, in which case this would serve as good educational purposes for you to see how we underwrite deals, see how we present deals, and understand our investment philosophy a little bit better. So today we are really just going to be walking through the investment summary, and we're going to be sharing with you all of the high-level details of this investment. We're also going to be covering at the end here a pretty detailed question and answer, because we really want to make sure that we're answering all of your questions and giving you all the information that you can need. So again, we have acquired, we've identified an opportunity for 100% ownership interest in Anchor Mobile Home Community. Now, the interesting thing about this community is that it's a hybrid mix, unit mix, a total of 163 units with 89 mobile home lots, 65 self-storage units, 6 single-family homes. And then at the front of the property, there's also a commercial office building, which has 3 office units in as well. So this is a rare opportunity to have a really combined unit mix here and leverage on all of these different income sources. You know, it's pretty common for us to have a single family home with a mobile home park or maybe a few self-storage units, but it's a really good opportunity to have this complete unit mix that we have here today. So this property is located in the fast-growing city of Spartanburg in South Carolina, and the actual park is located less than 15 minutes from downtown Spartanburg, 20 minutes from Greenville Spartanburg Airport, and 30 minutes from Greenville, South Carolina. And if you're familiar with the area, South Carolina is one of the fastest growing states right now, especially with all of the lockdowns and everything that happened with the pandemic last year. People realize that they can work remotely. They no longer have to be locked into certain cities. And so people are starting to move to areas that they want to move to. There's a lot of amazing advantages and benefits of living in Greenville and Spartanburg in South Carolina. And one of the things that I actually do is I track macroeconomics, because I want to see where's the economy moving, where are people moving, what's going to be happening in real estate. So I've got the highest likelihood of understanding the best probabilities so we can make the best business decisions. And one of the interesting things that I've found through this research is that South Carolina is one of the fastest growing states, and that last year when everybody's starting to move out of these bigger cities and moving out of Southern California and moving out of New York and Chicago, one of the top areas people are moving to is South Carolina, and some of the top cities that people are moving to in South Carolina is Greenville and Spartanburg. So we really get to leverage from all of these people coming in. The demand is really off the hook for affordable housing, which we're going to touch on a little bit later, but we're really excited with this asset, this property. We're also really excited about this market as well. So the basic business plan that we have with this property is to purchase with attractive debt terms. We're going to talk about the debt terms a little bit later. And we're also going to increase occupancy by remodeling the vacant homes, filling them with qualified tenants. We also have some vacant lots in the mobile home park where we're going to, it's our plan to go out and purchase new homes. We also have the opportunity to buy used homes at our leisure as well, and then fill those vacant lots and then fill those homes with qualified tenants. We also have 6 single family homes, and 4 of which we're looking to remodel pretty much straight out of the gate. And then we've got another 2 there that are already occupied that we can remodel a little later on. We also have currently some of the utilities are billed back to the tenants. Some are not. So the park is currently absorbing some of the utilities, and it's our intention to bill back the utilities. And we've actually underwritten, even though we're going to be collecting probably close to 100% recapture on our utilities, we actually underwrote in this deal that we would only recapture with about 90% to give some wiggle room for the usage that the park has, for the general maintenance, and a little bit of utilities that we would use while we're remodeling some of our homes there as well. We also plan to go in and renovate the office units and also the self-storage facility, rebrand the self-storage facility, and then transition some of our park-owned home tenants over to home ownership programs so that we can get some of that park-owned home inventory off the books, reduce our risk. And then also we intend to improve the aesthetics of the exterior of the homes, as well as the landscaping throughout the park, the entries, the general cleanliness and curb appeal. There's also some road repairs to be done as needed. But the really, really cool thing about this property is that the main roads that go through this park are actually maintained by the county. So we really don't have to, the park doesn't have to absorb much of that cost. There's just a few roads inside there that we need to maintain, and we'll do that on an as needed basis. And we'll also be improving the infrastructure on an as needed basis as well. And then it's our intention to increase lot rent, park-owned home rents, self-storage rent, office rent, and single-family home rent throughout the whole period. We're going to talk about how we're under markets, how much we're under markets on rents. We're going to talk about that in some of the coming slides. And then we also project to refinance at the end of year 3. Now, this is an interesting thing that's mixed into the business plan here, because the projected hold period for this investment is 7 years. However, because we're starting off with a relatively low occupancy, we get the opportunity to increase that occupancy in the first 3 years, which consequently massively increases the value of the property, which in turn gives us the opportunity to refinance at the end of year 3 is when we're projected to do that. And it's our intention at that point to be able to return original capital invested to our investors, with the intention that at that point they would have a zero balance in this investment, yet investors get to remain in the investment and enjoy the following 4 years of cash flow and equity with essentially zero risk in the deal. So that's one benefit about the refinance for investors. The second benefit is that because investors will be receiving their original capital invested at the refinance, they would receive that back at the end of year 3 based off our projections. That means investors can go out and redeploy that money, reinvest it in something else to provide more returns. But the interesting thing is the way that we've underwritten this deal is as if investors are not going to reinvest that capital, because there's no way that we could project what that investor is going to reinvest in and at which point they will. So just know that there's extra additional benefits to being able to reinvest that capital and put it to use so you can compound your returns for the last 4 years of this investment. And then again, we have a projected 7-year hold term for this property. And we're in a rapidly growing market of Spartanburg and Greenville in South Carolina. And we're really, really excited to improve the revenue, to reduce the expenses, consequently driving up the NOI. And it's our intention to do this through our vertically integrated or affiliate property management company, which we own in-house. We manage our own properties. We manage it from the asset side and from the property management side off-site, because we believe that that is the best way to control the net operating income, which makes more profit for you, our investors, and it makes more profit for us as well. We really find that it's important to have that control in there to improve the economy of the financials of our investments. And then just quickly looking over at our offering summary here, we are coming in at a purchase cap of 6.83%. Now, market cap rates in this market are around about 5 to 6% range. So we feel pretty good on the purchase there. And I believe that at the end of year 2, based off the purchase price, our cap rate comes in slightly under 8%. So we feel really good about the cap rates there. And you will see that our exit cap rate, we've actually underwritten with 8%. Now, we feel that it's highly unlikely that cap rates would be as high as 8%. Actually, we're seeing cap rates compress. It's our expectation and anticipation that cap rates would continue to compress. But because we can't control the future and because we can't control every single outcome, we need to make sure that when we're underwriting these deals, that we have very conservative underwriting terms. And so we underwrote with an 8% exit cap rate to give us tons of wiggle room should cap rates rise for any reason over the next 7 years of this hold period. We're also coming in with an expense ratio of about 50%. And then with the improvements and occupancy increase, that drives down to about 35% by year 7. We're going to go over those details in the projections and Proforma later on. And then we're starting off with a mobile home lot occupancy of 75%. And it's our intention to drive that up into 100% over the hold period. We've got a purchase price of $2.67 million, hold period of 7 years, and the total equity or the total capital required to come to this deal is it's a little under $2.4 million. And we'll have a breakdown of exactly how that capital is going to be sourced and used later on in these slides. So, let's just talk a little bit about the return structure that we've got set up for this investment. So we've anticipated for limited partners, which is also called Class A investors, receiving an 8% preferred return. So first off, let me just explain that a little bit more detail. So we have all of the revenue that comes in for the property, and we have all of the expenses that come out of the property, and then we're left over with some cash flow. Well, how are we going to use that cash flow? Well, we've got here that the first people to get paid is actually investors, okay? And investors have an 8% preferred return. So that means that the first people to get paid is 8% on whatever investors have invested, and that's on an annual basis. So 8% of what they invested. So if an investor invests $100,000, then they would be getting paid $8,000 that year as a preferred return. And then after that, 100% of all remaining cash flow goes to investors. Okay. And then the one caveat on that is that if in any singular year before the refinance, if an investor exceeds 12% cash flow in any given year, then at that point, we would split 50-50, and the remaining cash flow after that, 50% of which would go to investors, 50% of which would go to sponsors. And so that's the way that we've got that set up there. But really, the way we have this structured is because we think it's really important to pay our investors first. That's why we've got it structured this way. And as we're going to break down through this return structure and the partnership structure here a little bit more, you're going to realize that the sponsors or us, the operators, we actually don't essentially get paid until after the refinance, until we've returned capital to investors, because we think that that is the best way to put investors in a good position. And it also highly motivates us not only to meet our business plan, but to do everything we can to exceed that And we're very, very performance-based company, and that's the way that we structure our deals. So we also have the intention here that at year 3, there would be a refinance, at which point it's our intention to return the original capital invested to investors so they can go back out, they can redeploy that capital, and then they can hopefully compound the overall returns by making a return on a second investment. There's definitely a benefit for investors there. And then after the refinance, because the original capital has been returned to investors, and now at that point, they'd essentially be in the deal for zero. They essentially have no risk in the deal. Their original capital is returned. They've already claimed cash flow for the first 3 years. So at that point, if there was any capital left in the deal, say, for example, if an investor invests $100,000 and we're only able to return $99,000, well, if an investor still has $1,000 in the deal after the refi, then investors will still get an 8% preferred return based off the remaining capital balance that they have within the investment. And then after that is met, then the excess cash flow would be split. 50% would go to LP investors, 50% would go to sponsorship partners. And another thing that I'd like to point out here is, and this comes up sometimes, is what happens if the preferred return cannot be met in any given year. Well, the long and the short there is, if we're projecting to provide 8% preferred return, and if in a given year we will only be able to provide 7%, well, then that remaining 1% would roll over into the next year, and then we would owe 9% the next year to catch up for it before any excess cash flow gets split after that as well. And then upon the sale at the end of this projected 7-year hold period, equity will be split. 50% goes to limited partners, 50% goes to general partnership, AKA the sponsors. And then the minimum investment on this one is $50,000. And we anticipate quarterly distributions and reporting. And so typically when we send out our distributions, we're also going to send out our profit and loss. We're also going to send out a detailed report on what's happened in our operations over the last quarter and what we're anticipating in our operations in the coming quarter. So you can follow along, you can hold us accountable, and you can see as everything unfolds. We like to be pretty transparent with our reporting and our financial reports as well there in our quarterly distributions and reporting. And then at the bottom here, you're going to see, again, our partnership structure. So the preferred return is 8% on this deal. Excess cash flow above that is 100% goes to limited partners, unless that exceeds 12% in any given year. And then that would get split 50-50 thereafter. And then the equity and cash flow is split 50-50 after the refi. And again, if there was any investor capital still remaining in the deal after the refinance, well, before that cash flow split, the 8% preferred return would still be paid to investors based off their capital balance. Minimum investment, $50,000. Purchase price, $2.67 million. Hold time, 7 years. And then the total equity required, $2.37 million. Okay. So I am going to pass the baton over to Nolan Freeland right now, who's also my business partner at Cultivate Collective, and he's also operations manager. And he is definitely a big brain behind a lot of these numbers. So I'm going to have Nolan share a lot of these numbers with you.
Exactly. Thanks, Bryce. So as you guys can see here, this is our return summaries based on our underwriting. And we've got our total equity here of $2.37 million. And then, we go through here. I'm going to quickly pass over the LP net fees and returns because Bryce is going to come back and touch on that. But our total project IRR is 20.24%. And then down here, we have our sponsorship structure of our acquisition fee of 2%. We also have an asset management fee of 2%. As Bryce touched on, our preferred return of 8%. And then our promote after the refi, the cash flow is split 50-50. And the sale proceeds would be as well. And just to touch quickly on the acquisition fee and the asset management fee, we're not into nickel and diming our investors. We don't charge a bunch of fees. These are basically just to keep the lights on and compensation basically for running the deal. And again, just to keep the lights on. Touching over here on the right side, this is our projected cash flow amounts based on a minimum investment of $50,000. As you can see here in year 1, 2, and 3, we've got 8%, 8%, and then just over 9%. And then right there at the end of year 3 in that last column, we have a return of capital of almost $50,000. And then you can see the projected cash flow basically on that, like $76 left in the deal here. Actually, it's less than that. Yeah. And then down here at year 7, we have our, again, proceeds from the sale. Bryce, do you want to quickly touch over on these net returns and fees?
Yeah, so let me just piggyback what you were saying there about our acquisition fee, asset management fees. So, the acquisition fee, what's that all about? Really, we're out there, we're finding these deals, we're doing the marketing, we're building the relationships, we're getting them under contract, we're negotiating, we're performing due diligence, we're getting the loan. There's a lot of things to do to pull these deals together. Basically, that's just some very, very mild compensation to be able to cover us for a lot of our efforts. It really doesn't, it's not a huge amount to us, but it does just give us a little bit of compensation for our time and efforts there, because obviously that's worth something. But like Nolan said, we're not big on charging fees. We're big on providing the largest cash flow and equity that we can return to our investors. That's what we're big on, and we're performance based. Okay, so if our investors aren't getting paid, we're not getting paid, and we're not doing this to not get paid. So we're really highly motivated, and that's why we structure our deals this way. But the asset management fee, you're probably wondering, it says 2%, but what's that 2% of? Well, it's 2% of gross income. Okay, and that gets paid to Cultivate Collective, which is our asset management company, for taking care of the day-to-day, and basically, like Nolan said, just keeps the lights on. It pays for some of our staff, it pays for the logistics. We don't really make any money on that. It just allows us to be able to cover the cost for us to be able to do that. Also, it's not mentioned on this page, but we also have a 5% of gross revenue is a property management fee. Now, that's also an affiliate company of ours, Innovate Collective, where we take care of the offsite operations, and we make sure that we're overseeing the onsite managers, the onsite teams, pushing through the business plan, overseeing and managing all of the contractors and all of the construction work and everything like that. And again, that 5% fee, we're not walking home with a bunch of money. It's really just paying for staffing, it's keeping the lights on, and it's covering the cost for us to be able to do that. Really, the reason that we have the property management company in-house is so that we can control the net operating income. We can control the finances to the best of our ability. There's nobody on this planet that is going to manage this property as well as us, because we are the ones that have the most motivated to provide the biggest returns to our investors, which consequently gives us the biggest returns. And we're certainly in this industry and this business to be able to do that. So that's why we have those fees there. And then the acquisition fee, 2% of what? That's actually 2% of the purchase price. Okay, now talking about these net fees and returns. So we have a limited partners or investor IRR of 15.43%. Now, you guys might be thinking, well, that looks pretty good. The reason there's actually an asterisk beside that is because, and I mentioned this earlier, but this IRR is calculated based off investors not reinvesting their capital when they receive that back at the refinance at the year of end 3, which I'm assuming all of you are going to want to do. And investors that join us in this deal are going to want to reinvest that capital, put it back out there to work, further compounding returns. But the reason why we have to work with these numbers is there's no possible way that we would ever be able to know what investment each investor is going to invest in, what the return structure of that investment is, and at which exact point in time they would reinvest their money. So for all of our investors here, holistically, for the group of everybody who joins us in this deal, we can't anticipate that. So we can only underwrite based off that 50,000, here, if we're using the minimum investment, the $50,000 being invested up front, then at year 3, the $50,000 being returned to that investor so they can go and redeploy it, invest it in another deal, which would obviously provide compounded IRR, compounded returns, which would drastically increase this number should that second investment provide returns. Now, which I'm assuming that all of you are savvy investors and that you would be investing in something that's providing returns. So that number can drive up. And then you'll see the asterisk is also by the annualized return and the equity multiple as well, because consequently, while the IRR increases, given that compound effect of reinvesting that capital, also the annualized return holistically for the capital investing would increase, and so would the equity multiple as well. So that's really, really one of the advantageous benefits for this, that we're actually getting a lot of interest from all of you. We're getting a lot of positive feedback that you guys really, really like the option, that you get to stay in this investment for 7 years, but you get that capital returned in year 3. Essentially, you're risk-free at that point because your capital has been returned. Anything that's beyond that is just pure profits. And you get to redeploy that and reinvest it, compounding overall returns. So really, really wanted to point that out, and that there's no way we could possibly calculate how that would work for each individual investor, because we don't know their individual circumstances. Now, also there, you're going to see the average cash on cash. Now, this is in the net fees and return section. The average cash on cash before the refi is 8.4%. Okay. So that might sound good, but what is the cash on cash after the refi? Well, that's an interesting question. And the reason that's an interesting question is because we're under the assumption that the investor capital is going to be returned at the refi. So the investor's capital balance is essentially zero, or very, very close to zero. So to actually have a return on investment at that point, where an investor has barely anything, if anything, in the deal, it just throws that number astronomically through the roof. And if we were to actually project that number in our underwriting, it's going to show over the 7-year hold period that the average cash on cash is like 230,000%. And so obviously that's a number which looks kind of crazy, but essentially we're at the point where we're providing either like, a massive cash on cash return or an infinite return, because there's no money left in the deal at all. So just wanted to point out that really the year 4, 5, 6, and 7 cash on cash return is going to be a massive astronomical number. And so, but we underwrote way more conservatively there, based off if the investor still had the $50,000 in the deal, just from a cash flow perspective from year 4, 5, 6, and 7. So that's really the main points that I wanted to touch on here. And then again, the acquisition fee is paid to sponsors. That's paid to Cultivate Collective. We are your asset management company for this investment. Okay, investment highlights. So we talked a little bit more about we talked before about the business plan. Let's just dig into that a little bit deeper here. So one of the things that we're going to do is we're going to infill lots. Okay, so there's some vacant lots right now. Currently, we have 19 vacant lots in the community, and the projected plan is to bring in 11 homes in year 1. It's our intention to bring in new homes, and then 8 homes in year 2 to fill the vacancies. How are we going to achieve this? We're going to leverage programs like the 21st Mortgage Cash Program. Performance Equity Partners has a similar program, and we've got other third-party companies that also provide programs like this. Let me just quickly explain how these programs work and how this ties into these business plans. So 21st Mortgage actually has this program where we, the park owner, we could go out to a home manufacturing company. Let's say, for example, we're going to use Clayton Homes. We'd go to Clayton Homes and we go, okay, we want to buy 11 14 by 70 mobile homes. We want this kind of countertop. We want this kind of bathroom. We want these upgrades. Cool. And then we let Clayton know what our order is. At which point Clayton Homes would say, okay, who's going to pay us? And then we'd turn that over to 21st Mortgage and we'd say, hey, 21st Mortgage, we've lined up to purchase these 11 homes with Clayton Homes. And then 21st Mortgage would step in and they would actually proceed with the purchase of those homes, okay? Which would then have those homes be ordered. And then the homes would start to be built. And then a few months later, or right now we're seeing about 5 to 6 months later, a home would magically appear in our community, or in this case, 11 homes would magically appear in our community. Now, up to this point, we have got 0% in these home purchases so far. The park has 0% in it so far. When the home shows up, at that point, it's the park's financial responsibility to get the home set in place, to get it tied down properly and signed off by an inspector, get utilities hooked up, the decks and skirting on, and make it all set up and ready. And that costs around about $6,000, give or take, for each lot. So at this point, we've got about $6,000 in the deal. What happens next? Well, the park advertises for a tenant, just like we would on any other tenant. We have all the applications come in, we process the applications, boom, we've got a qualified tenant. Excellent. Now we pass on that qualified tenant to 21st Mortgage, who then goes through their additional screening process. Once 21st Mortgage says, yes, these guys are approved, they sign a lease with us, they pay lot rent to the park, and they pay the home payment to 21st Mortgage. When they have this kind of setup, this means that the tenant is the homeowner, and the tenant is responsible for the repairs and maintenance for the mobile home, which works for us magically. Also, what happens at that point is 21st Mortgage says, okay, you guys spent $6,000 on getting this home set up. We are going to reimburse you that $6,000. So now that we have found a qualified tenant, we've got that mortgage and everything signed, we are going to reimburse you. So then again, we'd be in that deal for 0% or zero cost, because we'd have that $6,000 reimbursed. Now, you're probably thinking, this sounds magical. What's the catch? Well, there is a catch, because what happens if the tenant doesn't make their mortgage payment or doesn't make their home payment to 21st Mortgage? Well, that's where we, the park, would have to step in, take over. We'd end up evicting the tenant for non-payment of rents, and then we would end up getting the home back, essentially. And at that point, we would have to go out and go through that whole process again. And we've got 6 months to be able to find a replacement tenant, at which point we would go through the same process. But then this time, there's a little bit of a difference, that when this new tenant signs the loan documents for the second time, the park would be putting in 10% as a little bit of like a security backstop. And then the tenant would be putting in about 90%. So that would be basically how things get split up. So when we do actually have someone that defaults, and then the park has to come in, find another tenant, there is that 10% cost of the home value that we end up absorbing and having a little bit more skin in the game. But still, that's a very minimal cost. And even if we're talking about a $60,000 home, it's brand new and it's got all the bells and whistles, we'd still only be in it for $6,000. Now, that's really, really amazing, especially when we get to amplify that by 19 lots in this community. We can bring in 19 lots where each lot has a value of somewhere in the 30,000s, but we're doing that for like $6,000 or less per lot. Creates an amazing spread for us from an investment perspective. We really, really love leveraging these programs. And again, we've got 21st Mortgage, Performance Equity Partners, and a handful of other third-party companies that can provide these financing for us. Okay, so one of the next things we're going to do is operational improvement. So we're going to be bringing in one of our top performing on-site managers to live at this park and manage this project. This on-site manager is absolutely outstanding, really, really strong strength in sales, understands management, understands the business and construction side of things, of MHP ownership. So we're bringing in our top on-site manager to this project. So we're really, really, really excited about that. And we're also going to be bringing in our favorite construction company. We've been working with our top manager and top construction company for years now. We've got really, really strong relationships. We're really, really excited. This is going to really keep our construction costs down, because it's essentially being done almost in-house. And, so we can keep our material costs down. We can keep our construction costs down. We really, really love working with this construction company. They take massive action. They're really good at implementing, and it helps us keep a lot of our operational and CapEx costs down. And they're really both our our manager and both our construction companies are really, really personally engaged in the projects that they do when they work for us. And they also, we know that if we leave something with them, we can guarantee it's going to get done. So we really, really love working with that. It makes us feel so much better about this investment because we're really working with some of our top teams here. One of the other things we're going to be doing here is a utility bill back. So currently, we do not have all of the waters individually submetered. So we're going to throw in some digital submeters there that get read digitally, and then those readings get added to tenants' bills, and then we can essentially bill back 100% of the usage there. But we've underwritten so that we're only going to recapture 90% of that, just in case the park uses a little bit of water. And utilities when we're remodeling homes and doing a little bit of general maintenance around the park. When we do this, that reduces our expenses, it increases our income, and it drives up the net operating income. And we really, really love that because consequently, that massively increases value to the purchase price. So we love utility bill backs, and we're definitely going to get to leverage that. And we're going to use our favorite meter installation company for that one there. Next thing here is refinance. So it's our anticipation to refinance before the end of year 3, at which point it's our intention to return all of the investors' original capital invested, or as much of it as possible, reducing the risk for investors and also giving them the additional opportunity to go back out there and reinvest that capital, compounding returns. And then another thing that we're doing is renovations. So we currently have 3 vacant park-owned homes that are sitting there ready to be remodeled. So we anticipate remodeling those year 1. There's also 6 vacant homes that we anticipate remodeling as well, straight out of the gate. Now, the exit strategy. So we mentioned that it's our anticipation to have a 7-year hold period here. And look, we're anticipating cap rates to still continue to compress. We've seen that happen in the mobile home park space for recent years. It's happening right now. Again, we're probably in a 5 to 6 cap market here for Spartanburg and Greenville for mobile home parks, self-storage. But we've underwritten with a 7% cap rate at refinance to give us tons of wiggle room there. We've also underwritten with a 8% exit cap at the end of the investment cycle here. But we're expecting this to stay in the 5 to 6 cap range, if not even compressing a little bit further. So any of the projections you're seeing here are all based off these 7% cap rate at refinance and an 8% cap rate at exit, just in case crazy things happen with the economy, interest rates massively increase, and then cap rates increase in alignment with interest rates. We feel like we've got tons of wiggle room there. And so we feel really confident with that conservative underwriting. Speaking of which, conservative underwriting, just wanted to cover some of the reasons why we believe we're conservative here. Now, before I dig into this, I'm just going to stop and say, I know most of you, whenever you see an investment, whenever an investment's projected to you or presented to you, the operating partner is always going to say, we have conservative underwriting. Now, I'm going to throw out something here. I'm actually going to throw out a challenge to show me another mobile home park operator that has equal or more conservative underwriting than us, because I really believe that we're not just taking into consideration conservative on 1 or 2 of our metrics. We want to be conservative of every single metric that we have in this so that we can cover ourselves should anything go wrong in any of these metrics, because it's our intention to not only provide you with the returns that we're stating here, it's actually our higher intention to do better than that and to perform better than expected. We totally want to overperform. So we underwrite with a lot of different metrics. Here's where we've been conservative. We underwrote with one of the office units being remodeled and leased and rented by year 2. We actually expect achieving this by year 1. Which is also it's also going to validate our new rental amount as well. So currently our rents on the office units, I believe, are $350. And we're going to look at these numbers in a minute, but we can claim $500 or more for those units straight out of the gate. So it gives us good wiggle room there. Market lot rents are $415. Lot rents are currently $374. So we've got about, $40 there that we have in spread. Now, even though we could raise our rents straight out of the gate, and we may even do so, we underwrote with not raising those rents until year 3. Okay, we want to remain conservative. We want to take into consideration all of the things that have happened with the lockdowns and the pandemic and what could happen in coming years. So we didn't want to be aggressive and throw in all of these crazy maxed out rent raises. We have tons of wiggle room in our rent raises, and it's our intention to raise rents much quicker, much higher than what we're stating here. But again, we wanted to remain conservative. So about $40 under market lot rents, and we underwrote to not even raise rents until year 3. Same thing with park-owned home rents. We could easily get $250 to $300 for park-owned home rents right now. That's for used homes, and $450 plus for new homes. We've actually got some stats actually right here. We ran some test ads for our used mobile homes. We want to see a result of about 30 responses in about 10 days. However, we ended up getting 144 responses on our used mobile homes. So we massively exceeded the demand there. And on our new mobile homes, we had 221 responses. So, very, very amazing response there. All we needed was 30 in each of those. We know that there's a massive demand for affordable housing in this market. And I mean, look, we only have to fill, I think it's 19 lots with new homes. We've got 220 people that called in the first 10 days. And so we're going to have no problems filling these vacancies at all. We feel really good about that. The demand's there. And again, we're well under market. So we can demand $250 to $300 for used homes and $450 plus for new home rent. But currently, our average park-owned home rent's only $143. So we're massively under market there. Tons of room to raise rents. And then market rents for offered units are $500 a month. We're currently at $353. And then market rents for single family homes are $750, where we're currently at $588. So we've got tons of room for rent increases. And we are actually, it's our intention in our operations to be aggressive with our rent increases. We know we have tons of demand. The market can support it, but we wanted to underwrite with conservative rent increases. And also, we underwrote with a 6-month lag on leasing post remodel. So what does that mean? It means when we go in and remodel a home, we've built in a 6-month period of how long it will take to go out, find a tenant, get the lease signed, get them in the home, get them start paying rent. From what we're seeing, that's going to be a month or less from what we're seeing with our demand, but we didn't want to underwrite like that. We wanted to have tons of wiggle room. We want to have things in there that can allow us for crazy circumstances and shutdowns and lockdowns and whatever stuff that could pop up in the future. So we've got a 6-month lag on leasing post remodels there. And so that actually what that does is that some of our rent increase numbers or our occupancy increase numbers that actually would be happening in year 1 roll over in our underwriting to year 2 because of that 6-month lag. So we believe that we're extra conservative there in our underwriting and our return projections. And then the other thing is that the current owners have had limited use of the self-storage unit. So basically, we've got 65 self-storage units in the property. Now, right now, we have a 0% occupancy in these units. Now, previously, there was 45 of these units that were being rented, but then management, who has been just basically neglecting this park. This park has basically been neglected. The owners of the park are really multifamily, or the sellers of the park are multifamily apartment investors. They got involved in mobile home parks. They went out, they bought a bunch of them, and then they realized the management's very different. So they effectively stopped managing these parks, and they basically just kept it alive. And in that lies an amazing opportunity for us to come in, be aggressive with our construction and our property management, and really clean up all of the things that they could have done, which leaves tons of wiggle room in the deal for us. So what they did is they ended up having the self-storage units. They didn't want to manage them. So then they kicked everybody out, which is absolutely crazy, blows our mind. Most of the units are in fantastic condition. Some of the doors need to be replaced on the units. We're going to rebrand. We're going to repaint, fix up some of the gutters and everything like that. But really, they're looking in good shape. And also, the previous owners or the sellers of this park never advertised for self-storage, period. They had it completely restricted to people that lived in the community. And they still had 45 units rented. We're going to be going in and cleaning up the park. One of the things of cleaning up the park is holding tenants accountable for keeping their lot clean, keeping their yard clean and the outside of their home clean, which consequently means some of the stuff's going to have to be removed out of the yard and placed into storage units. So we feel confident that we're going to be able to fill up a lot of those units just with people living within the park. But then in addition to that, we're going to be opening this up to the general public. There's a lot of people in the general market here that we would also be able to leverage to fill those self-storage units as well. We underwrote to bring in, to bring our single family homes to market rents in year 2. But in all honesty, it's our intention to actually do that in year 1. We're going to be going in there and knocking out those remodels straight away. And then we can demand higher rents as soon as those remodels are finished. And again, we've had amazing demand for our single family homes. We wanted to get a response of 30 as well. But over 10 days from our test ads, we had a response of 91 people. So we're seeing massive demand for all of these rents, even at these stated prices, which leads us to believe that we've got tons of wiggle room in actually demanding higher rents in this market as well. And going back to the self-storage, we underwrote with filling 16 of these self-storage units each year. And it's actually our intention to fill those significantly quicker, but we want to be conservative and we didn't want to overstate anything there. Market cap rates in this area are currently 5 to 6%, and we underwrote with a 7% cap rate, 8% cap rate. I've mentioned that a couple of times here. We also underwrote with a refinance interest rate at the end of year 3 at actually 6%. So I'm going to correct that. It says 7% here, but I'm actually going to correct that and give you guys the updated investment summary here. So it's 6% at refi. But what's going to happen is after at the point of refinance, our occupancy is going to be up. The aesthetics are going to be up. We've already been told in advance this would qualify for agency debt. So our interest rates, if we're going off today's times, would be in the low 3% range, maybe even in the high 2% range. But we underwrote with a 6% interest rate at our refinance because we don't know what's going to happen between now and then. Things can be a little bit volatile right now, and we wanted to, an increase of like 3% in an interest rate over 3 years. That's really astronomical. So we feel like we've been very conservative there, and it's our anticipation to get good debt for this at the refi time. We also anticipate billing back trash, water, and sewer within the first 2 years. We underwrote with a 90% recapture. That means that we've underwritten with the park using 10% of those utilities that are being billed back. And the likelihood of us actually using that full 10%, very unlikely, even if we have underground water leaks. So we feel like we've been very conservative there. But we didn't want to overstate anything here. And again, we want to be conservative on all of our metrics. So we anticipate our expenses being as low as 35 to 40% out of the gate, whereas currently out of the gate, we've underwritten at a little under 50%. And then trend down to 30 to 35% after the refinance, where currently we've underwritten for 35 to 40% after the refinance. So it's our intention to have lower expenses, but interestingly, in our expenses, we're built in for inflated material costs, inflated labor costs. The cool thing is right now, it seems like material costs are going down. Hopefully that's the case, and hopefully that continues to be the case for the next 7 years, but we can't rely on that. So we have underwritten in our capital expenditures and our repairs and maintenance and all of our materials costs and labor costs. We've massively built in tons of extra padding there. In a lot of cases, we've doubled our pricing, because we want to make sure that should prices continue to inflate, should material prices continue to go up over the long term of these next 7 years, then we have really have built in a lot of wiggle room there. So we feel good on that. In addition to that, it's our intention to knock out all of this construction as soon as possible because of that reason, because we really want to mitigate ourselves against inflating construction labor and material costs, should that be the trend that happens in the next 7 years. So we really are doing everything possible to knock out most of the construction in year 1 and year 2. Which is going to mitigate those costs from increasing as much as possible. But again, we've doubled a lot of our construction costs there to give extra wiggle room. We don't have travel expenses on this property because it's located 1 hour from my house. So, apart from a tank of gas and a few meals down there, then, on site visits, and we're really not going to have any travel expenses. We also gave a 20% expense ratio to our park-owned home and single-family home rent. What does that mean? Well, I talked about expense ratios before, and that relates to the lot rent. But when we've actually got our park-owned home and single-family home rent, there could be repairs and maintenance that's tied to those park-owned homes. Well, the interesting thing is that one, we're actually remodeling these homes. We're remodeling the park-owned homes, and we're remodeling the single-family homes. So we're massively reducing the likelihood and the need for repairs and maintenance. Because they're going to be in top quality. In addition to that, we've also built in our capital expenditures, we've already built in to do further improvements to these properties. So we've double protected ourselves there, and we threw in an extra 20% expense ratio. Honestly, we feel like that 20% expense ratio is not even necessary because we feel like we've got it more than covered in our capital expenditures. However, we kept it in place to be conservative. Also, we've underwritten with a full remodel on the 4 single-family homes, and that's going to further validate high rents and keep the repair costs low. And we gave a 5% annual increase to property taxes, even though that's not at all the case right now. We know that there's quantitative easing happening right now. The Fed's printing more money, creating more currency. Someone's going to have to pay that back. More than likely, that's going to get passed on the general public through taxation in the form of price inflation, taxation in the form of increased property taxes, increased income taxes, and so on. So we wanted to build in there and take that into consideration. So we have a 5% annual increase in property taxes to mitigate for that. And then the compound effect of that over 7 years, we feel like we've got some good wiggle room there with increases, should they happen. And then we've also underwritten with 3 park-owned homes to be sold to tenants each year for 4 years until all 12 park-owned homes are sold. And then what we're going to do is we're going to weigh up the financial pros and cons versus keeping them and selling them at that point. And also, as operations unfold, because if we find that this market, that the people that are staying in the park-owned homes have really, really low repairs and maintenance, then they really are taking care of their homes, then it's our intention to keep the park-owned homes. We'll keep the income. We're not really worried about the risk at that point. But if we find that there's a little bit higher turnover, and look, turnover in the mobile home park space is so low, it's 5% nationwide. So we really, really don't have much turnover. But if we do have more turnover at this park and we do feel like there's a little bit more wear and tear on the homes, then we have the built-in opportunity here to convert these homes to home ownership programs. We underwrote to do that over a 4-year period. We could do that in a much sooner time frame if we wanted to. We have the flexibility in there to be able to pass on those homes to tenants, take them off our books, reduce the risk, or keep them. And if we feel like the risk is actually worth it, and then we can keep the higher cash flow there as well, or the higher revenue coming in from that additional home rent income. Okay, so just going back here real quick. I know we talked about a lot of these metrics, and each of these metrics alone, we feel like gives us enough wiggle room for that particular metric. But then we look at all of these combined, and we really, really feel like we've underwritten this deal very safely, very conservatively. And we've done that because look at where we are right now. Look at what happened last year. Look at what's happened at some points through this year. We have to take all of these things into consideration. So we want to be able to protect ourselves for all of the things that are out of our control, all of the things that are in our control. And then when we holistically look at this and compound all of these conservative underwriting metrics together, we just really feel like we've got lots of wiggle room and we feel confident with our projections here. So there are 3 vacant park-owned homes and 6 single-family homes that need remodeling. A couple of pictures of those homes there. And we've budgeted for $8,000 for each of the 3 park-owned home remodels and $6,000 for, and sorry, $25,000 for each of the 6 single-family home remodels. Most of that's aesthetic. And again, we've got our own in-house, well, it's not essentially in-house, but it's our top construction company that's going to be working very closely with us on this one, knocking out all these remodels and keeping the costs down. So it's our intention to stay below budget. We have padded in there lots of extra wiggle room for price increases, for material increases, yet it's our intention to knock out as many of these remodels that we can year one, mitigating our price increase risk, and then our intention to come under budget there. So we also have the potential to fill 19 vacant lots at this park. We spoke about that before using the 21st Mortgage Cash Program. I don't really need to dig into that any further here, but here's some of our lots. Basically, our lots are developed in this park. We've got the utilities going to them. Some of them may need a pedestal here and there, but apart from that, we're looking pretty good on having our prepared lots. We also talked about installing water meters and billing back the meters. We use digital meters that get read digitally. And we also have this really, really cool system that if for some reason someone has much higher bill or the meter's reading higher than what it normally does historically, then we get a red flag that goes to us. It also goes to our on-site manager. And then we can go and inspect that home and find out, is there a water leak? Is someone left a tap running? Is the toilet leaking and we've got a run going there, or is there a water leak going somewhere on there? It allows us the additional ability to be able to mitigate those water leaks and to jump on things much quicker, which is awesome. But the main reason we have it is so that we can bill back utilities. And again, it's our intention to bill back 100%, but we've underwritten to only recapture 90% of that. And we've underwritten for that to be fully implemented by the end of year 2. Yet that's our intention to do that year 1. Okay, Nolan, because you are the numbers guy, I'm going to pass the baton to you so that you can talk about our CapEx budget.
Certainly. So this is just kind of a quick summary or rundown of, our CapEx budget from all the equity that we're raising. It was the 2.37 million. As you can see, a total 1.4 million of that is going to CapEx. And really our largest line item on this is the bottom one, and we'll get to that in a second. But we've got 398,000 for, updating and maintaining roads. Doing quite a bit of landscaping. As you can see, like there's a ton of leaf pickup to do. We'll use some gravel our driveways, and really just kind of soup up our entrances and, our lots, and just overall improve the aesthetic of the park. We're also going to redo the signage. Bryce mentioned that we have a fair amount of aesthetic work to do on the self-storage to bring that up to our standards and what we think would be, great to have outside clients or tenants for our storage. And then we also have a fair amount of that going to our lot prep, be it pedestals or piers and pads, and everything like that will go there. And then we have 391,000 budgeted for our 6 single-family home remodels. We have our 3 vacant park-owned mobile home remodels. And then we're also going to remodel 2 of our office suites over the first 2 years, so we can justify our higher rent prices and meet the market's demand. And then you can see here, we also have $120,000 budgeted for our new home purchases that we're going to bring in. And, that's a lower number because we are going to use and implement the 21st Mortgage Cash Program or the Performance Equity Partners. We have another 42,000 here budgeted for self-storage, and that is, redoing our doors, painting, gutters, could be security. That's what all that's going to go to. And then the bottom one here is we have infrastructure repairs budgeted here, 449,000, which is going to be as needed. This park is on a mix of sewer and septic, and some of that is also going to go to implementing our water meters for all 90 mobile home lots, including the houses, which is a fair amount of that. And then again, doing septic repairs as needed or sewer repairs and connections as needed for our new lots bringing online and everything else like that.
Yeah, and I'm just going to piggyback that one, those infrastructure repairs. So the cool thing is, so yeah, we do have, we've got city water on this property. We don't own any of the other utility systems, except we do actually have a mix of septic systems and city sewer as well. Now, the cool thing is we've got a city sewer main that actually runs through the park. We have the opportunity to be able to tap into that city sewer main. So that's certainly in our intention. We'll do that on an as needed basis. And that's why we've budgeted a lot of wiggle room in there. We feel like we've got enough in there for wiggle room on price inflation, material costs, and things like that as well. So we're going to be knocking out that part of the project straight out of the gate and going really hard to just get all of this construction done as soon as possible. Beautiful. And then again, we mentioned at the end of year 3, managing partners anticipate refinancing the property. We've underwritten with a conservative 7% cap rate. And we've also underwritten that at our refinance, that we have a 6% interest rate. And then the plan at the refi is to return the original capital invested from investors, return that to investors. And then we have a little chart here of our debt financing. Now, here, this is actually our acquisition debt financing. So this is the principal balance. That's a 70% LTV, interest rate of 4.5%. And then we have the first 5 years of the investment is fixed at 4.5%. And then we have a floating rate after that. And then that's, I can't remember exactly how many basis points it is above the 5-year treasury. But it basically, the interest rates would have to massively increase between now and year 5 for the interest rate to actually go up. So here's the thing. We're looking to refinance at year 3. However, we have the wiggle room here we have 10-year balloon on this loan, on the acquisition loan. Now, it's certainly not our intention to hold it in, for 10 years. We really want to do that refi. Interesting thing about that is we told you we're performance-based before. We, the operating partners, your sponsors, we don't get paid. Essentially, we don't get paid anything of any real significance until investors' capital is returned to them, at which point we end up claiming a 50% split on cash flow and equity thereafter. So really, it's our intention to do that refi and to get that capital back to investors as soon as possible because we get paid after that. You obviously, the investor would want your money back so that you can go out and redeploy that as soon as possible, further compounding your returns and the overall investments. And so, but we wanted to have wiggle room because if all hell breaks loose and the economy just goes absolutely haywire, we want to know that we've got something, we're locked in with our interest rate for 5 years. So we feel good there. And then we've got a floating rate under that. But again, interest rates would have to go through the roof for that to be higher than 4.5% from year 5 to 10. But we do have a built-in 10-year balloon should everything go crazy, should it not make sense to refinance at that point. Certainly not our intention. Again, we want to get that money back to our investors as soon as possible, but we just want to cover ourselves for any of the potential risks that could be involved with the volatility of the economy and the markets and everything like this. But the cool thing is that we actually have the prepayment penalties are not going to ding us. We have the opportunity to refinance with the same lender at no penalty. And even if we refinanced with another lender, I believe after year 3, there is little or no penalty at all for refinancing. So we've built that in. We feel good there, but we've got tons of extra wiggle room should the markets go absolutely crazy. Then, property overview. We've already talked about this before. 163 sites. We've got 89 mobile home spaces, 65 self-storage units, 6 single-family homes, 3 commercial office units. Pretty cool to have that kind of mix. Doesn't happen every day. That's an aerial shot of the park there. You actually see the self-storage units there and then that commercial office building in the front. and some mobile home parks, some mobile homes at the back. Cool thing about this park, decent sized lots. We can bring big homes in. We love bigger homes. We love bigger lots. It allows for larger families who stay longer, who are less transient. There's also much higher demand. And as you saw, collectively, we have over we have over 320 responses for our mobile home test ads, where really we only needed 30. So more than 10x there. So we feel really good. Nolan, we're back to numbers. I'm going to pass the baton to you so you can walk us through these numbers here.
Absolutely. So this first kind of chart here is property information, which we've already pretty much covered. Our purchase price, 2.67 million. We have 12 park-owned homes, and that means we have 60 tenant-owned homes, which is a pretty awesome mix, and will definitely help when we go to refinance and get attractive debt terms. As we already mentioned, our water is public, which the community is currently paying. We have a mix of city sewer and septic systems. The community is also currently paying for trash, and then our electricity is directly billed to the tenants. And then down here, which is what we really wanted to get onto on this page, is basically our unit or site mix and our occupancies. So our mobile home lots, we've got 89 total mobile home lots. Currently, 70 of those are occupied. And again, out of that 70, 60 of those are tenant-owned homes. And then we have 19 vacant lots. And as also, our current average lot rent on the park is $374. And our market lot rents through our market research and our comps is $415. So we've got, we're under market about $40, $41 there, which we're excited to take advantage of it and bump our rents up over the first 2-3 years of our hold period. Out of our single family homes, we've got 6 of those scattered throughout the 16-acre parcel that we're purchasing here. Only 2 of those are occupied. We've got 4 vacant single family homes. And out of the 2 of those that are occupied, the average rent between the 2 is $588. And we believe that we can get a minimum rent on those of $750. And we believe that we can actually exceed that through our renovations that we do on the vacant ones. Also for our commercial office here, we've got 3 actual office suites. One of those is used as the park office. We've got one of those that is occupied, and we have one of those that was just recently vacated. And so, our plan is to renovate 2 of those. We're actually going to move the park office into a smaller suite and rent out the larger space. We believe, obviously, that'll maximize our value. And our current average office rent is $353 on the one that is rented. And, we believe that we can push that up to a minimum of $500 a month, given that our market comps of price per square foot and everything else going on down there, and our commercial frontage that we have along that road. And our self-storage facility, we've got 65 total units, and currently there is 0 occupied units. Ton of upside there. 65 vacant units, and based on our market research, we can get anywhere from $30 to $50 a month per unit, depending on the size, if it's a 5x10 unit or a 10x10 unit. So yeah, we're excited to take advantage of that as well.
Beautiful. And just to add a little bit more depth on that, our market rents that we've got here are on the low end of our market rents. So market rents are ranging from these numbers and above. So we wanted to bring in the lower end of the market rents, but we believe that we can push higher than those numbers. And especially with the demand we've received, with all of the people, telling us they're interested at our current pricing, then, the market pricing that we've got displayed there, and we feel really, really good about the demand. This is a overhead aerial view of the community. So you can actually see it there, and you can see this in winter. So this is some of the trees that are not evergreens. You don't see the leaves there, but actually this time of the year, a lot more greenery there, a lot more shade. Okay, financial analysis. Nolan, I know you're not going to get into this on a granular level. I know you're just going to hit it from a high level, but you just want to just walk us through this one.
Yeah, exactly. So this is just a quick snapshot of our basically 7-year hold pro forma. And I'm sure we've had some numbers people who are watching this. And, if you want to, feel free to pause it and dive further into the details here. But I'm just going to kind of run through the basic way to read this or look at it. So obviously our first columns here is our income columns. And this is our gross, where it says lot rent through other rent, which is our commercial office space. That's our gross potential rent. And then through there, we take into account our utility income, fee income, which would be pet fees, late fees, application fees. Then we have our loss to lease, which we have built in, our vacancy loss. And then basically all the way down here, this bottom bronze line, about a third away on the page, is our effective gross income. And you can see this first column here is T12, so that's the seller's income. And then we break it down on a per unit number. And then we go through and we have, our projected pro forma from year 1 to year 7. And then below that, we break it into our operating expenses. And again, T12, this is the seller's operating expenses. And then because we are professional mobile home park operators and the sellers weren't, we believe that we can operate this better through, our knowledge, experience, economies of scale, and also increasing our revenue through our business plan. And so we have our expense ratio in year 1 around 50%. And, I guess ultimately our goal is to have our expenses trend down, which we believe that we can do, but we've also tried to remain conservative given, inflation or rising material and labor costs. And then our bottom line here, which is the exciting one, is our net operating income. As everyone knows, if we can control our NOI, then we can control our sale price or our value on the property.
Absolutely. And just to add a little bit more color on the whole expense ratios there, you're like, well, actually, if you guys are building in for price inflation, why are those expense ratios going down over the 7-year period? And the reason for that is Nolan touched on it, is because the occupancy is massively increasing. So as the occupancy increase, and as we have an economy to scale, our expense ratio decreases. But in addition to that, we've actually got built in an expense increase each year. So we are actually under the assumption that we are going to have an expense increase, but because of the massive occupancy increase, that's why you'll actually see that number overall trending down there. And then a little footnote at the bottom here, 5% management fee is paid to the affiliate of sponsor. That is going to Innovate Collective, which is our property management company, which we detailed before. And again, that 5% fee, it's based off gross income, and pretty much keeps the lights on, allows us to be able to pay for our staffing, paper and printing and stuff like that. So we don't really actually get to see any of that. Where we get paid essentially is by the cash flow and equity after the refinance. So we are very, 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 very motivated to get all the money back to our investors as soon as possible. And we hope that you appreciate that too. So Nolan, you want to keep talking about these numbers here?
Yeah, exactly. So this next slide is our projected financing and cash flow. The main thing I want to highlight here on this top table is the asset management fee. That is the 2% fee that we spoke about in the beginning that gets paid off of gross revenue. And again, this is just to keep the lights on. It goes from 8,000 and just kind of subtly increases as we increase our gross revenue, basically through our business plan. And then you can see here we've got a quick summary of our acquisition debt service from our initial acquisition loan, and then also our refinance. But the main thing I want to highlight on this page is the second part of it, which is our projected LP distributions. And so the first line item here, we have our LP contributions, which is the initial equity that we're planning on raising. And then through there, we have the one below that is our distribution. So this is going to be our cash flow. And the first 2 years, we have an 8% return of 189,000 and change. And then you can see here, year 3, we've got a large number, 2.5 million, almost 2.6 million, and a star next to it. And that's because we have our refinance proceeds, a return of capital here, on top of like a 9.19% cash flow return that year. And then, it goes down through year 4, 5, and 6, basically because your return of capital has been returned. And then in year 7, we have, $800,000 in change, which is your cash flow on top of the sale proceeds. Which, Go ahead.
Exactly. We've got a footnote down the bottom here. It actually breaks down the difference between the equity that's received at the refinance and at the end of year 7 at the sale event, which you can actually back that number out, and then you'll be able to know how much cash flow is actually allocated to those years. So just check out that footnote down the bottom there. Another thing that we want to point out, Nolan said it before, the asset management fee, that's 2% of gross revenue that gets paid to us, Cultivate Collective. Again, just keep the lights on. But yeah, so the thing that we really wanted to point out here is those distributions for the LPs, and then you might have a look there and you'll say, well, hey, wait up a minute here. There's the limited partner contributions. It seems like all of the capital coming to the deal, and yes, that's the way that we've underwritten here. However, it's the GP or the sponsor's intention to be able to bring in the minimum investment. Okay, that's our intention, to bring in the minimum investment, but we underwrote like this because when we bring in the minimum investment, or even more than the minimum investment, that's going to further drive up investor returns anyway. So these are more conservative numbers. And we also wanted to allow for the possibility of more investors to be able to get involved in this deal. However, it's our intention to bring in the minimum investment on the GP side or on the sponsor side. So just wanted to point that out for some of you that may be looking at it and going, hey, wait up. Are the operating partners going to be putting any money into the deal? And the answer is yes. So you can see that there as well. So this slide we've actually talked about previously. There's no point going over it again. It was earlier in the presentation. And then here is our sources and uses. So Nolan, you want to just give us a breakdown here?
Yeah, absolutely. So we've already touched on a lot of this, especially the CapEx budget, but this is just a total breakdown of the equity that we're raising, the total 2.3 million, and basically where it's going and how it's being allocated. So we have our loan amount here as the first line item of 1.8 million, our purchase price of 2.6 million, and then we have, again, our CapEx budget, which we've already broken down. And then so where's on top of that 1.4 million, where's the other, I can do the math on that super quick, 900,000 or whatever it is and change going. And so basically we have our closing costs of 170,000, and that's broken down into our lender costs and our loan guarantor fees. We have a due diligence cost of 53,000. We have an estimated closing costs of 26,000, which includes attorney fees, syndication fees, everything like that. Here again is our acquisition fee, which is 2% of the purchase price. And again, our loan guarantee fee as well.
Yeah, I'm just going to touch on that loan guarantee fee. So there's actually, we've talked about all the fees and we keep pointing it out because we just want to be real clear and real transparent. We're not fee heavy. We basically just do the bare minimum to make sense in the deal. The loan guarantee fee is basically it's 1% of the loan amount for us signing on the loan and guaranteeing the loan. And then you'll actually see later on in the investment, again, there at refinance time, the only other thing that sponsors would be receiving is 1% of that refinance loan amount. That fee would also go to us, the affiliate sponsor. It would be going to the guys who are signing on the loan there, guaranteeing the loan. So that's basically the only fees that we charge there. We don't charge like disposition fees or any other fees like that. We just want to be really, really clear on our fees here. Anything else you wanted to touch on this slide, Nolan?
Yeah, exactly. I guess the only thing I would say is on top of the 1.4 million and 170,000, obviously the rest of that investor equity is going towards our loan down payment.
Mm-hmm. Yes. Excellent. So market overview. Okay, we spoke about this earlier. Don't know if there's really that much of a need to dig back into it again. But again, if any of you are out there and you're following the Great American Migration, which is what it's being called, which is basically because of the lockdowns and everything that happened last year, people started moving out of cities, moving into different areas, and now people are moving to areas that they want to live because they don't have to physically be somewhere for work. Very desirable area in the Spartanburg and Greenville markets. So we are seeing a lot of people moving to these markets. And although you might go onto bestplaces.net to find out what the statistics are, or you might go onto city data and you might find out what the statistics are, a lot of those statistics are actually out of date. They haven't updated for what's been happening in 2020, 2021. We do a lot of research. We go on to find out, where are the U-Haul trucks going? Where are different people moving to? Where are people moving out of? And South Carolina, one of the top states, it's in the top 5 states of where people are moving to. And there is we're just seeing a lot of people coming in, hence the demand that we've seen when we talk about getting responses to our test ads. So also a couple of statistics down the bottom here. It's the number 1 best place for young professionals as far as niche is concerned. It's in the top 10 for best cities in the US, and for Condé Nast Traveler. It's number 10 for the best places to live in the US from livability. And it's number 12 best places to go in the world as per the New York Times. So a little bit more information on the market here. You guys can read this at your leisure. Pretty good foundation of top employers. We've got some stats here on the Greenville MSA area and some of the top employers there. And you can see some of the branding down the bottom there. So seeing a lot of growth, seeing a lot of movement happening in these markets, a lot of improvements happening. And if you've been there yourself, you would know that these markets are actually pretty attractive. Not only are they great places for people to want to come and live there. There's a lot of people that go down there for vacation and check it out. And again, really cool thing is it's 1 hour from us, 1 hour from 1 hour drive from my place, very close and easy for me to check out. Here's a little bit of demographics data here, which you can actually check out at your own leisure there as well. And then we've also got a map. So on this map over here, top right, top left-hand corner, you're going to see that's where Anchor Mobile Home Park is. And we are 15 minutes from downtown Spartanburg. I think it's 20 minutes from the Spartanburg Greenville airport, and then 30 minutes to Greenville. So get to tab onto not only the Spartanburg MSA, but we also get to leverage the Greenville MSA because they kind of cross over. And in this area, when people talk about Spartanburg and when people talk about Greenville, they talk about them synonymously and together. And it's usually called the Greenville Spartanburg area or the Spartanburg Greenville area. So we get to leverage on both of those MSAs. So what does that mean for us? It means that we can really, really fill our vacancies. We've got no problems doing that at all. We look again at the results that we got from our test ads. And then also it allows us to pull from a bunch of different contractors. If we need to use different contractors, there's nothing worse than being stuck with one plumbing contractor in a one pony town. So we've got tons to pull from in Spartanburg. We don't even need to go to Greenville to pull any contractors. Plus we've got our own contracting company down there. But if we did, we do have the opportunity to be able to tab on to the Greenville MSA as well and pull some good price contractors from over there as well to work in the community. So we really, really feel like we're in a great position in this market. And those who know the South Carolina area, very, very, very attractive market to be in. Couple of case studies here. I'm not going to go through these, but you can just see a little bit of our track record. You can see what happened at purchase, what our business strategy was, and then our results since takeover. A couple of properties in there. And then let's just quickly talk about management team, your sponsorship team. So I'm Bryce Robertson, lead sponsor and growth manager at Cultivate Collective. I take care of overseeing all of the day-to-day operations, big decision-making. I mean, this is my wheelhouse. A lot of you that are listening to this are listening because you've built relationships with me over the years, or you've built relationships with our sponsor, who has also been building relationships with me over the years. And I mean, this is what we do. So I am very involved in a lot of the operations for the asset management company and property management company. I'm not the kind of leader who's just leaving that to everybody else. I'm very involved in the process, and I get to check and balance everything. We've got a great team that works with us. So really, really excited about that. We've also got Nolan Freeland, who's our operations manager, Cultivate Collective. He really digs on a more granular level on the day-to-day, and also working with our property management company as well. And then we've got a couple of co-sponsors joining us on this deal. We've got Matthew Owens from OCG Properties. We've also got Chris Larson from Next Level Income. And we have Alpesh Parmar from Wealth Matters. And then just quickly, just touching on our vertically integrated property management company, Innovate Collective. Innovate Collective, we're driven by providing exceptional tenant and vendor experience while simultaneously innovating and obsessively increasing the bottom line for our property owners. Cool thing is that we essentially work for ourselves. So we are highly motivated to be an exceptional property management company. And then the same thing with our asset management company, Cultivate Collective, who is presenting this opportunity to you today. And then a little information here on our tax advisors and accountants. We use CFO consultants. These guys are top notch. Really, really, really great, which helps us. We can do cost segregations. We can do accelerated bonus depreciation, take a lot of benefits, a lot of tax advantages from mobile home parks. I'm not a CPA. You'll have to, talk to your own CPA about that. But we're really excited about CFO consultants. We love working with them. And then our two attorney groups or law groups that we work with, our Premier Law Group, who we work with for our syndications. The cool thing is Mauricio, who owns Premier Law Group, the lead attorney there, he is a mobile home park owner himself. He is a mobile home park syndicator himself. I'm glad that someone who controls or handles our syndications is actively doing it. He is a mobile home park guy. He loves mobile home park. He understands the ins and outs. We really, really love working with him on our syndications. And we also work with the MHP lawyer for our transactional attorney for any of the day legal stuff. And again, do I even need to explain this further? They are called the MHP lawyer. Ferd Nierman, top attorney over there. He's also a mobile home park owner, operator, syndicator. These guys know the industry. They know the mix. They're actively working in the industry. They're actively investing in the industry. And we really feel really, really, really good about our solid team that we have working with us. Little bit of additional information here. So a little bit of question and answer. So first off, we've just got a couple of questions here. And then we also have had quite a few questions come in via email. So Nolan, you can read out those questions to me and we can dig into those too. But I just want to make sure that we're answering a lot of your main questions here. So question number one, when does my preferred return start to accrue? Well, that's from day one of operations. Also, next question, when should I expect my first distribution? Well, we anticipate the first distribution to go out after the first full quarter of operations. In fact, 45 days after the first full quarter of operations would be when the first distribution could start. Can I invest using my self-directed IRA? Yes, we accept IRAs. We also accept cash and qualified international investors as well. And then qualified international IRAs or their equivalents. We actually have, some investors from Australia that like to invest using their self-managed super funds, which is the Australian equivalent of a self-directed IRA. So yes, we are open to all of those. And do I have to be an accredited investor to participate in this investment? This is a 506B offering. And so those of you who understand 506Bs, we have an unlimited number of accredited investors that can join us on this investment. Then we have up to 35 qualified non-accredited investors that can also join us in this investment. So we're from SEC terminology, we're open to accredited investors, unlimited, and we can have up to 35 non-accredited or also called sophisticated investors. Will the offering utilize debt financing? Yes, purchase. We are getting debt. We also explained those terms earlier in this presentation here. And then again, we're looking to refinance at the estimated at the end of year 3. So we're definitely going to leverage that. We're seeing great loan terms out there right now. There's amazing programs for mobile home parks. Fannie and Freddie's in on the mix, and we'd be up to qualify for those programs at the refinance period. So we had tons of loan offers for this property. We had tons to select from. A lot of lenders want to work with us on this one, and we're going to have a lot of opportunity to work with a lot of lenders at the refinance, but we'll probably go with the lender that we're actually using with the acquisition. But nonetheless, a lot of demand for people wanting to provide financing for this, and we're seeing excellent loan terms right now, which we love to leverage. It's a really good time economically. When you look at the macro economical environment and cycles, it's a really good time to leverage cheap debt, and we're certainly going to be doing that. Last question here in the Q&A is that can I sell my shares before the offering is liquidated? And the long of the short of that is yes, it's a possibility exists, but there's no guarantees. But really, the main thing is if that's a question that is like a big concern from you leading into this, if there's a high probability that you think you're going to need to pull your money out of the deal before that refinance event happens, we would suggest not getting involved in the deal. Okay. The possibility there exists. There is a process that we can go through, but there's no guarantees there. And we'd certainly help you out. We'll certainly do whatever we can. We know that some kinds unforeseen circumstances pull up and people have crazy needs that need to be met in a short period of time. We'll do everything humanly possible that we can to help out given those circumstances. But again, if you think it's a high probability coming into this investment, we would suggest, don't get involved in this investment. Consider it as if you are not going to receive any of that money back until the main chunk of your money back until the refinance event. So I wouldn't count on the possibility of you liquidating your shares mid-investment. Certainly not something that you would want to count on. Okay, staying on the question and answer, actually, I know we've had a lot of questions come in. Nolan, I know you've got these questions. Let me know what we got.
Yeah, absolutely. We actually do have quite a few to get through, but they're all good questions. So the first one we're going to start with is, what is the likelihood of reinvesting our proceeds from the refinance with you?
Oh, okay. So that is based off the assumption that we refinance at year 3, investors get back all or near all of their original capital investors. Will at that point we have investment opportunities for investors to reinvest in? We can't answer that question. We can't say a definite yes, but the likelihood is looking great, at least at this point. We're in massive acquisitions mode. Unless something changes between now and then, the likelihood of us being able to have some type of investment for investors to redeploy their capital into at that point, the way based off of what we're seeing right now, we feel really good that that's a higher probability than being a lower probability.
Great. So our next question here is, in the investment summary, you mentioned that the IRR compounds, consequently increasing our overall IRR when we reinvest our capital after the refinance. Will any of the other return metrics be affected by this also?
Oh, okay. Yeah, I believe we've covered that pretty well, but let me just touch it again. So we've got a 15.543 IRR on this one, but that's taking into consideration that the investors don't reinvest that original capital that gets returned to them at the refinance. Should an investor go out and reinvest that capital in an investment that provides a return, it's going to consequently increase the overall IRR on that capital. And then also other return metrics would increase, like the return on investment, the equity multiple as well. And we've actually got, we've detailed that on the projections and assumptions for our return projections. So you'll actually see some footnotes detailing that on in our investment summary.
Great. This next question is, at the end of year 3, when we plan to do the refinance, would we be forced to refinance in unfavorable economic conditions?
That's a really good question. So it's our intention to refinance at the end of year 3. If we can do it quicker, great. But what happens if we get to that point and interest rates are like 10% or something like that. Of course, that's a pretty pie in the sky number. But if for some reason it just doesn't make sense to refinance at that point, we're not forced into it. We mentioned this earlier. We've actually got 5 years of having our interest rate locked in at 4.5%. And then we also have the opportunity to stay in that loan for 10 years. We've got a 10-year balloon term on there as well. So we've got a lot of wiggle room. We're not forced into having to refinance there. But again, we really do want to refinance because we get paid after we return original capital to investors. That's when your sponsors, your general partnership, that's when we're really starting to make some bank. Obviously, we're not doing this for nothing. We're highly motivated to get to that point. So we are going to do everything that we can that makes financial sense. But again, we really wanted to build in that whole long balloon period for the acquisition loan. So it gives us wiggle room should the sky fall and things go absolutely crazy between now and the refinance.
Awesome. So this next question is pretty much along the same lines as the previous one. And this person asks, what will happen if you don't refinance at the end of year 3?
Oh, okay. Yeah. So let's just say the economical circumstances are crazy. It just doesn't make sense to refinance year 3. And then we end up refinancing at the end of year 4 instead. Well, for that extra 1-year period, investors still have their capital invested in the deal. Investors are still going to be claiming an 8% preferred return on that capital that's in the deal. And then 100% of the excess cash flow above that goes to investors until they make a 12% annual return. Then it goes 50-50 on the cash flow there. So basically, it means more cash flow. And then when we finally do the refinance at the point in which it makes sense to do so, then original capital gets returned to investors, and then we continue with the post refi 50-50 split.
Excellent. Next question. I see that you've underwritten a refinance cap rate at 7%. If cap rates continue to compress and we end up with a higher valuation than you've underwritten at the time of the refinance, will you pull more cash out or just enough to return the initial investor capital?
Okay. So it sounds like that question is if at the refinance point the actual value of the park is higher than what we've stated in our underwriting, are we going to pull out more cash out of that refinance than what's needed to pay back investors? And I believe that it's our intentions to just pull out enough to pay back investors. At the same time, we will be looking at the market. At that point, we'll be looking at loans. We'll be looking at loan terms and interest rates and weighing up the pros and cons. We don't see any need in pulling out any more money than paying back investors. But should for some reason something make more financial sense to do so at that point, we would cross that bridge when it comes.
Great. It says on the investment summary, the year 1 through 3 average cash on cash is 8.4%. Wouldn't we receive a significantly larger cash on cash return due to our return of capital after the refinance?
Yeah, and I touched on that before earlier. Basically, yeah, the 8.4% cash on cash return is the annual average for the first 3 years. However, after that, we've underwritten that the refinance happens end of year 3. Original capital gets returned to investors. And if they have a zero capital balance at that point, then after that, from year 4 onwards, they'd be making infinite returns. Now, if we actually underwrote like that in our underwriting and just showed that there was infinite returns, we don't believe that that is actually the most valuable way to present a deal. So we actually presented this deal as if there's I think it's $47 of a capital balance would still be involved in the deal, just to show that the number of return on investment, instead of just having an infinite return year 4 onwards. But actually, when you look at that return on investment, it's over 200,000% or something like that. It's ridiculous because the investor doesn't have much money left in the deal, if any at all, yet they still get to claim on 8% of preferred return after the refi for any capital they still have in the deal. And then after that, 50-50, the excess cash flow gets split. Cash flow increases as the business plan moves on because we're increasing the occupancy, we're increasing the rents. So it's a really, we believe that we've put investors in a sweet position from year 4 to year 7. They get to claim on the cash flow, but they've got their money back and they get to redeploy that in another investment. So if you actually look at the overall cash on cash, it would be astronomical and through the roof, if not infinite after the refinance.
Great. Can you speak a little more on the vertically integrated property and asset management companies that you mentioned?
Yeah, we kind of covered that a couple of slides ago. Innovate Collective is our in-house property management company. Cultivate Collective, our in-house asset management company. The reason we have it set up like this is because there's absolutely nobody on the planet that is going to take care of our investments as well as we are. We pay a lot of attention to detail. All of you that know me know that I have a really, really strong background. I've got 20-year background or 20-year plus background in construction and construction management. That's why we love these value add deals. We're really good at understanding the red flags and how to handle contractors and negotiations and the ins and outs. And how to effectively push through the business plan, keeping construction costs low as possible. So for all of these reasons, we actually keep in-house property management. We've got vertically integrated asset management as well, because nobody is going to take care of these investments as well as we do.
Next question is, in your opinion, what are the top risks of this project and how are you going to manage or mitigate them?
Yeah, that's a really good question. And that's actually a question that I wish investors would ask more often. One of the top risks that we have is price inflation. And we talked about that earlier. We have seen material costs increase. We have seen labor costs increase. And so to mitigate this in our underwriting, we've actually massively inflated the cost of construction. In some cases, we've doubled costs, even though it's our intention to knock out this construction as soon as possible. Most of the construction we're expecting to be complete in the first 2 years. So we've actually built in a lot of price inflation in our capital expenditures and our operating expenses to mitigate from that as well. The cool thing is that even though we've underwritten like that, we're already starting to see material prices are coming down. Hopefully it trends more in that direction. But we didn't want to guarantee that there was going to be the direction things were going to go. So we've built in a lot of wiggle room in our capital expenditures to cover price inflation should it continue to increase. So that's one of the risks that we can foresee. Another one of the major risks is, again, we touched on this before, a lot of quantitative easings happening, AKA money printing or currency creation, whatever you want to call it. Someone has to pay that back. So we're anticipating the possibility of taxing being increased. Again, going through price inflation and then also property taxes as well. So we've built in 5% property and tax increase to actually mitigate for that. And, another risk that we can foresee the potential of is interest rate increases as well. So the likelihood of the interest rates increasing 3% between now and refinance is we believe, quite low. However, we underwrote with a 6% interest rate at the refinance, just be able to mitigate for any potential interest rate increases. We don't holistically really believe that interest rates are going to increase too much in the next few years. Maybe it's a little bit harder to project 2 years out, but we feel pretty good over the next 12 months. The US has so much debt. If interest rates increase, debt increases as well, that can cause a lot of other problems. So at this point, it's to our best knowledge that interest rates aren't going to be increasing massively. However, we wanted to underwrite just in case they did, because it's out of our control. And I really think they're the top risks involved in this deal.
Great. And then our last question here is, what's the next step to get involved with this investment?
Sure. So far, first step is you've already built a relationship with one of the sponsors of this deal. That's absolutely essential. And then you've received an email offering where you've actually seen the investment summary and then you've received another email that's given you this recorded webinar. So you've got enough information to be able to look into the deal. At this point, once you've watched the webinar, once you've gone through the investment summary and read all the details, if you have any more questions, reach out. More than happy to dig into that. Our contact details are going to be shared on the last page here. You feel free to give me a call or schedule a call with me. You can do that through my email link. If you're actually working with one of our sponsors, then contact your sponsors directly. I'm more than happy to jump on calls with you and discuss everything. But really the next step is once you guys decide that this is the kind of investment that you would like to be involved in, the next step is giving a soft commitment. Now, it's not binding. You don't have to fully commit to that, but we do please ask that only people that actually put in a soft commitment are people who are seriously intending to invest in this deal. We've had an astronomical response from investors this year for our investments. Our last two investments filled in less than a week. So we really oversubscribed very quickly. Yes, this is a little bit of a larger investment than the last two that we've launched this year, but we're seeing a lot of demand up front. We're seeing a lot of interest. We've already had a lot of amazing feedback. So we do believe this is going to fill quickly, not by any means wanting to push any of you, only want all of you to move at a pace that you feel comfortable with, but do want to reiterate that if you are interested in this deal, if you are wanting to move forward or you are wanting to explore the possibility of moving forward as a high probability, reach out to us as soon as possible and claim your soft commitment, which would secure your position. And basically we work on a first come, first serve basis. I'll get to that a little bit more in a minute here, but you'll be letting us know, let your sponsors know what your soft commitment is, how much you're intending to invest. The minimum investment for this one is $50,000, and then it increases in $1,000 increments thereafter. So let us know your intended investment amount, and then also let us know how you intend to invest. Are you intending to invest with cash? Are you intending to invest through your self-directed retirement account? How are you going to be investing in this deal? Let us know that. You'll go on the soft commitment list, and then shortly, this is the webinar that you're going to be seeing. Shortly after the webinar, you are going to be able to receive the private placement memorandum, and all of the legal documents, the operating agreement, subscription agreement, all of the legal documents for you to review. That is only going to be seen by people who have placed a soft commitment, who really have all of the intentions to invest in this deal. And then at that point, you can go through all the legal documents and have another opportunity to jump on a call with me, to be able to shoot an email if you have any questions, talk to your sponsor, talk to myself. We'll help you through all of the legal documents, at which point, once you get through the legal documents and you believe that you would still like to move forward, that is when you would be signing all of the legal documents, which we would have set up for electronic signatures to make it easy for you all, and then depositing your investment amount into the LLC, then becoming a Class A member of the investments. And then after that, we close on the deal shortly after we've received investor capital. And then we proceed to take massive action on our takeover. And then fast forward, we mentioned this earlier, but after the first full quarter of operations is when we would be 45 days after that would be the earliest we'd be eligible to hand out the first distribution. And then we're anticipating quarterly distributions thereafter. And that's going to come along with financial reporting, also a detailed report of what's happened in operations in the last quarter, what we're projecting to happen in the operations in the following quarter, along with your actual distribution, most of which are automated payments, which go to investors' bank accounts. And then at the end of each year, or actually the beginning of the following year, we will be sending out K1s to our investors, and then investors can pass on that K1 to their CPA, who can then apply that K1 to their personal tax return. One of the beautiful things about mobile home parks is that even though we actually claim distributions throughout the year, and even though in the real tangible world we are making a profit on the tax returns, because of all the tax benefits, because of the cost segregation, accelerated depreciation, bonus depreciation, we end up having typically a loss on our K1s, which means that would be real taxes that you do not have to pay, real money in the bank for our investors and for you guys. So that's pretty much how that works. Again, we're not CPAs. We're not giving any tax advice. You'd have to consult with your own CPA to talk about the tax implications of this. But that is one of the additional benefits. We don't really dig into it too much because tax implications vary from person to person, but it is one of the definite main attractive benefits of investing in mobile home parks. We have very quick accelerated depreciation. Single family homes typically depreciate over 27 and a half years. We see in mobile home parks that's reduced to about 15 to 17 and a half years. Because we get to depreciate all of the improvements in the infrastructure and whatnot. So some amazing tax benefits that we see. Talk to your CPA about your tax benefits and how that would affect you. And also, if you have any questions on that, you want a little bit more information, you can connect your CPA directly with me and I can get them on the right track as well. So yeah, that pretty much wraps it up. So really the last thing is we just really like to thank you, appreciate you spending your time and dedicating to listening to this recorded webinar. We really, really hope that you got everything you need out of this. If you need any more information, feel free to reach out, email us, call us, get in contact with your sponsor. Make sure that if you want to get involved in this investment, that you go out and you place your soft commitment as early as possible to make sure that you secure your support. Again, our last two investments we've oversubscribed in a week. So we're expecting similar results from this one, even though it's a little bit of a larger capital raise. We are still seeing a lot of interest. So make sure to jump on that if this is something you're interested in. And we will be having the legal documents ready for review within the next week. So thank you very much for joining us today. And we look forward of the opportunity of you joining us in this investment so that we can increase our financial freedom and expand our wealth as we move forward and live towards having the most freedom that we can possibly have in our lives, which we're massive advocates of. So thank you very much for your time, and let us know if you have any other questions. Please feel free to reach out anytime. Thank you very much.